Now, is the rally here to stay?
Well, it looks like the Santa Claus rally came early this year. Janet Yellen delivering that market momentum on Wednesday with her comments. I think it may last through the end of the year. Of course, there are any number of things on the horizon that could throw markets back into a bout of volatility. But you know, the Fed essentially saying that they're on hold for a while, at least till the middle of next year, and not citing any of the risks they could have brought up associated with declining energy prices, concerns about Russia or Venezuela, or any of the other issues that are raising global concerns right now, means they're not worried about it, means the market's not worried about it anymore, and that certainly has helped support stocks here in the short term.
Now, you see the rally going through the rest of the year, but what about 2015? Do you see it spilling over?
I think the key to 2015, and yes, we do see stock markets rising globally in 2015, is better fiscal policy. Monetary policy gets so much attention, what the central banks are doing around the world. But the fact is we're not going to see a tax increase in Japan in 2015. That's off the table. We're seeing tax cuts in France and Italy likely next year. And even here in the U.S., we're actually looking to spend a bit more. So fiscal policy, rather than monetary policy, economic policy is going to be favorable next year, should lift global growth by maybe 0.5%. That should lift profits and help to support stocks in 2015.
Now, Jeffrey, you believe there's some other language that the Fed chose not to reintroduce that might be also playing into the markets. Tell me a little bit about that.
In the past, if you look back to 2011 or 2012 or even 2013, the Fed cited global stresses in financial markets as one of the reasons that they were cautious and remaining very supportive of the capital markets. Well, seems like they could have brought that back here, given all the concerns about Russia and Venezuela, the plunging oil prices, several other factors that have cropped up here recently in the high-yield bond market with spreads widening, tightening financial conditions, but they didn't cite any of those risks. And I think that's a sign that they just didn't see them as major concerns for the global markets, and that, I think, helped to encourage investors as well.